What's up guys, I'm so psyched to be back with another video and I'm so happy that you're here watching. So a few days ago I got this email again, and I get tons of emails every day, but this time it was another ad about yet another company that was going to do an IPO and go public in the stock market. And it's easy to get the feeling that after an IPO the stock prices just goes up a lot. But is this really true? I felt like it was time for me to really dig into this and investigate if buying stocks at the IPO is really a good idea. So in this video, we're going to take a look at why a company might want to go through with an IPO, how we can apply for stocks, and of course, most importantly, is it guaranteed that you will always make money on an IPO? Alright, so why would a company want to go public with its stocks? So a company that goes through an IPO or an initial public offering, as this acronym stands for, does this to raise more capital to the company. And this might be because they want to expand their business, they may want to finance an R&D project, or because the current owners want to sell part of or all of their shares. And with the IPO, the company goes from a privately traded company to a publicly traded company, and we can buy and sell their stocks in the stock exchange. So this makes it much more easy to trade the stocks, and it also gives some legitimacy to the company because it's more highly regarded to be a publicly traded company. There are also more rules and regulations for companies that are publicly traded, and this raises the prestige of the company. And this is actually one of the few times that a company itself will receive capital for its shares, because when we buy or sell shares that are already publicly traded, this is a form of second-hand trade between two outsiders and not a trade with the company itself. So the company doesn't get any money when you buy a share. So when a company goes public, they might offer retail investors like you and me to buy shares, and we will get this offer from a bank to participate. And it's also common that institutional investors like funds buy in, for example. So if you want to track upcoming initial public offers, you should have a look at the stock exchange websites. They usually have a section called upcoming IPOs or something similar like that. So how can we participate in an IPO? So when you get an offer to participate in an IPO, you have to answer how many shares you want to buy. And often there's a minimum as well as a maximum number of shares that you can sign up for. And it's not always the case either that you will actually receive the number of shares that you wanted, because many IPOs get oversubscribed, which means that there are more buyers that want to buy more shares than the company is actually issuing. So sometimes the company then would choose to issue more shares. But generally, when an IPO is oversubscribed, you won't get all of the shares that you wanted, or even any that you wanted, in some case. So it's the board members of the company that decides who gets the shares and how they're going to be divided. And this is done in conjunction with their financial advisor, of course. So sometimes they would choose to give everyone a certain percentage of what they wanted, or they might choose to give everyone the same amount of shares so that everyone gets shares for 500, say, independent of how many shares you wanted from when you signed up. Or they might choose to only give shares to some of the investors, maybe those that wanted more or larger posts, for example. Can you hear it raining? But don't go and sign up for more shares than you really want or can afford just to have a chance to get some. You might just get all of them. Before you decide to participate in an IPO, please read through the prospectus so that you know exactly what the company's business model is, how their economic situation is, and the risks that are associated with this company. You really should analyze this as you would when you're buying any share or stock that are already publicly traded. So ask yourself if you understand the company's economy, its earnings potential, and the industry where it's operating. And then it's also important that you take a look at what the company actually wants to do with the money that they will get from the IPO. Does it sound like a good idea? And is the company already profitable? Or does it even have potential to become that in the future? It's also good to take a look at if the company is planning to issue more shares in the near future, because this will dilute your current shares and likely lower the price of the stock. And importantly, are the current owners selling all of their shares and leaving the company? This is probably not a good sign, and you should probably not buy in then. And finally, do a Google search on this IPO to see if someone else has noticed something that you might have missed. And there's something else I want you to be aware of as well. And this is that there are companies that more or less consciously are scamming people into investing with the promises that companies are going to go into IPO soon. Often this is presented as a great opportunity to buy now because there is a planned IPO happening just in a few months. And of course now you have the chance to buy into a much lower price than what the stock eventually is going to be offered for to the public. But When a couple of months have passed, there's no IPO, and the scammed investors are in best case just stuck with shares that are challenging to sell because they're not publicly traded, and in worst case, they have lost their money and the company has filed for bankruptcy. If it sounds too good to be true, guys, it most often is. So there are no guarantees that this IPO actually will happen, even if a company says so. I actually remember getting this letter from a company a couple of years ago with this kind of offering, and after a quick internet search I found several posts about this specific company putting this into system and evidently raising money like this every couple of years. In my opinion, if a company that you're not currently a shareholder of themselves will send out mails about pre-IPO offers to random retail investors and don't go through some accredited financial institution, then this is not a good offer. If it was, then you can be sure that bigger fish would already have taken this bait, because you and me, we're certainly not the first one to get this question normally. But now, the most important part. Will you always be profitable if you participate in an IPO? And what's the best strategy in the short and long run? In fact, many studies show that IPOs often are underpriced, and initially after the public offering, the stock price often rises by 10 to 20% during the first few days after the stock goes public. And this has been seen when looking at so many different time periods: before the First World War, after the First World War, between 1932 and 1972, between 2007 and 2017, and a lot more different time periods. And this has also been seen when looking at different countries and regions. In the US, in Europe, in emerging markets, in Finland. Yeah, I think you got it. One of the countries where this effect is least evident is actually Canada, although it's still there. So, if the same pattern is seen when studying different markets and different time periods, then the effect is most likely real and not just a random pattern that we can see just because we looked at a specific region and time period. Alright, but after the initial stock price increase, it has also been seen that the stocks that IPO on average trail the general market index and similar stocks within the same industry on a bit longer time periods of 3 to 5 years after they went public. So the conclusion we can draw from this should be that if the stock prospectus looks good to you, then there is a good chance of making some money by participating in the initial public offering and make some gains on the initial price rise that often is seen within the first few days of trading. But then these are not stocks that you should want to hold on to any longer, as they often trail the market within the following couple of years. But remember that this is a general rule concluded from what happens on average after stock IPOs. And every individual IPO can of course result in something completely different. So there are no guarantees in the stock market. We can look at an example of a most recent IPO that was much anticipated, and this is of course Coinbase, a cryptocurrency trading platform that IPO'd on the 14th of April. Looking at the performance, we can see that the stock initially actually rose with about 4% after the third trading day. After a while though, it plunged around 30%. So this stock follows the average, where it initially goes up during the first trading days, but then so far trails the stock market over a longer period. And it also shows that there are no guarantees, even though this was really hyped and anticipated IPO. So please learn from this. Don't buy anything based on someone else's analysis. Promise me. Keep watching this playlist if you really want to learn how to analyze stocks, and I'll see you again next time. Bye guys.